Good morning. Today I am going to solve the eighth problem of depreciation. Let me explain the problem. Praveen Limited, PRA it is. Praveen Limited is a manufacturing concern. It provides the details of its assets as given below. Assets written down value as on 1st April 2019, then rate of depreciation. Furniture 2 lakh 10%, plant and machinery 5 lakh 10, 15%, then trucks 30%, land and building 10%, books 40%, patents 25%. Next is the following assets were purchased during the previous year. The assets purchased, the date of purchase and date of putting to use. So whenever the date of purchase and date of putting to use both are given, then we have to consider only the date of putting to use. So date of use only to be considered, not the date of purchase. So date of purchase is irrelevant. So we have to consider only the date of use. So assets purchased in the previous year are furniture in the month of June, the plant and machinery in the month of October, and a truck in the month of May, and books in the month of December 2019. Next, the sales in the previous year. The following assets were sold during the year. The furniture, then land and building, plant and machinery were sold in the previous year. Compute the depreciation for the assessment year 2020-21. So we will calculate one by one. We solve one by one. First, furniture, first block of assets 10%, written down value as on 1st April 2 lakh, then purchases in the previous year 1 lakh. Again, we have to consider the date of use only. Date of purchase is irrelevant. This is not important. Only date of use to be considered whenever date of purchase and date of use both are given. Next, written down value after purchase is a 3 lakh. Then sales in the previous year 60,000. Written down value before depreciation is 2 lakh 40,000. This value is important for our calculation, 2 lakh 40,000. Next, we will calculate depreciation. Total value for the depreciation is a 2 lakh 40,000. First, normal depreciation. So here normal depreciation only applicable. First, we have to calculate the asset which purchased in the previous year. The only one purchases in the previous year, that is in the month of June, 10th June 2019, and it was used from 12th June 2019. So we have to consider the date of use, not the date of purchase. For us, this is important, date of use is important, and date of purchase is not important. So value of the assets purchased, furniture 10%, and value of furniture purchased is a 1 lakh, and rate of depreciation is a 10%. So 10,000 is a depreciation on newly purchased asset. Next, on remaining value, the value for the depreciation is a 2 lakh 40,000. Out of that, for 1 lakh we have already calculated depreciation. Remaining value for depreciation is a 1 lakh 40,000 into 10%. The rate of depreciation 14,000. So here, in case of a newly purchased asset was used for more than 180 days from 12th June to 31st March. It was used from 12th June to 31st March. So number of days used this particular asset in the previous year was more than 180 days. So therefore full depreciation. So total depreciation for furniture is 24,000. The next block of asset is a plant and machinery 15%. The written down value as on 1st April 5 lakh 10,000. That is on purchases in the previous year, which was purchased in 2nd October and used from 9th October. So we have to consider the date of use for the calculation of depreciation. So purchases cost 12 lakh 10,000. So after adding purchases, written down value after purchase 17 lakh 20,000. Then sales in the previous year 1 lakh 30,000. Next, written down value before depreciation is a 15 lakh 90,000. The value which to be considered for the calculation of depreciation is a 15 lakh 90,000. Since there is a new plant and machinery, so we have to calculate normal depreciation as well as additional depreciation. Normal depreciation is applicable for all, even for the new asset as well as for the old asset. First, we have to calculate the asset which was purchased in the previous year. So only one asset purchased in the previous year, that is in the month of October, purchased in the month of October, 2nd October 2019, used from 9th October 2019. So we have to consider the date of use. Date of purchase is not required. We have to take into consideration only the date of use. So number of days starts from 9th October till 31st March. So here the new plant and machinery was used for less than 180 days in the previous year. The cost of new plant is 12 lakh 10,000. 15% is the rate of depreciation into half because it was used less than 180 days. Half is for half rate of depreciation because of use of because it was used for less than 180 days. So 12 lakh 10,000 into 15% into half. So depreciation value is 90,750. Next on remaining balance, only one assets was purchased in the previous year. So then we have to calculate on remaining value of depreciation. 15 lakh 90,000 is the written down value before depreciation. Out of that, for 12 lakh 10,000 we have already calculated the depreciation. That's the value of new assets. Remaining value is 3 lakh 80,000. 3 lakh 80,000 into 15%, it is a 57,000. So this is a normal depreciation. Next, additional depreciation on newly purchased assets. If it was used 180 days or more than 180 days, then 20% rate of additional depreciation. If it was used less than 180 days, then 10% rate of depreciation. Again, date of use only to be considered, that is used from 9th October. So used less than 180 days. The cost of new plant is 12 lakh 10,000 into 10% is additional rate of depreciation because by 10% it was used for less than 180 days. So additional depreciation is 1 lakh 21,000. So total depreciation 2 lakh 68,750. Next block of asset is a truck. 30% rate of depreciation, written down value 6 lakh 35,000, and there was a purchases in the month of May 2019 and which was used from 1st June 2019. So we have to consider date of use. The cost was 4 lakh 50,000 and no purchases. So written down value before depreciation is a 10 lakh 85,000. So we have to calculate depreciation. Only normal depreciation is applicable. The purchases, first we have to calculate depreciation on a new asset which was purchased in the previous year. So 4 lakh 50,000 is the cost, and into rate of depreciation is 30% because it was used for more than 180 days, 1st June 2019 to 31st March 2020. The number of days used more than 180 days. So therefore you have to apply full depreciation 30%. So 1 lakh 35,000 is the depreciation for new asset. And next is on remaining value. The value for the depreciation is 10 lakh 85,000. Out of that, for 4 lakh 50,000 we have calculated the depreciation. That's the value of new asset. Remaining value for the depreciation is 6 lakh 35,000 into 30%, 1 lakh 90,500. So total depreciation is 3 lakh 25,500. Remember, if even you can calculate directly on the written down value before depreciation. If you calculate depreciation on written down value before depreciation 10 lakh 85,000 into 30%, you are going to get 3 lakh 25,500. It's also correct method. You can calculate directly 10 lakh 85,000 into 30%, 3 lakh 25,500 you will get, because here the newly purchased assets was used more than 180 days. So whenever the newly purchased assets, if it was used for more than 180 days, then you can calculate directly on written down value before depreciation. No need to calculate separately. So I have calculated separately to help you to know how to calculate the process, or it is to understand to know the process of depreciation. First on new assets, if it was used for less than 180 days, then you have to calculate for depreciation first on that particular asset, then on the remaining assets. Whenever there are more number of purchases in the previous year, then it is better to calculate step by step. And even if there is more than all the assets, if it was used for more than 180 days, then you can calculate directly on written down value. If you calculate step by step, then it is easy to calculate. And even if you are well known about the depreciation, if you are understood the concept of depreciation, then you can calculate directly on written down value before depreciation. But if there are some new assets and if it was used for less than 180 days, then you have to charge half of rate of depreciation. That point you have to remember, otherwise you can calculate directly. The next block of asset is a land and building. 10% rate of depreciation. Written down value as on 1st April 11 lakh 10,000. Then no purchases in the previous year. Then sales in the previous year is a 12 lakh 50,000. So value before depreciation was considered as a nil, because you are going to get the negative value. You are not considering the negative value, means assets were sold. See, written down value after purchase, there is no purchases. Written down value after purchase 11 lakh 10,000, sale was 12 lakh 50,000. SEC is going to get the profit. Okay. It's a short term capital gain, or you can consider long term capital gain also, that dependent on the procedure of calculation of capital gain. But here the building was sold in the previous year. The selling value more than 12 lakh 50,000. So therefore return down, selling value is more than return down value after purchases. So therefore return down value before depreciation is considered as a nil. That's if there is a negative value, then you have to consider there is a no existence of asset. So depreciation is also nil. Next block of asset is of books. 40% rate of depreciation. Written down value as on 1st April of the previous year 80,000. Then purchases in the previous year on 12th December it was purchased, and date of use from 13th December. The cost 90,000. Next written down value after purchase is a 1,70,000. The sale was not there in the previous year. Written down value before depreciation is a 1,70,000, which the value which to be considered for the calculation of depreciation. So normal depreciation, first you have to calculate the depreciation on an asset which was purchased in the previous year, and it was used for less than 180 days. So therefore 90,000, the new purchased assets value, books value 90,000 into 40% is the rate of depreciation into half. So 1 lakh 18,000 is a depreciation, half because it was used for less than 180 days. Date of use, not date of purchase. Date of use 13th December to 31st March of previous year. So used for less than 180 days. So therefore half of rate of depreciation, 90,000 into 40% into half, or 90,000 into 20%, 18,000. Next on remaining value, the value for the depreciation is 1,70,000 minus 90,000. The value remaining value is 80,000. 80,000 into 40%, so 32,000. The total depreciation is 50,000. So that is in case of books. The next block of assets is a patents, 25% rate of depreciation. Written down value 12,000, no purchases, no sale. So written down value before depreciation 12,000. And calculate depreciation directly on a written down value, 25% into 3,000. Sorry, 12,000 into 25%. So you will get 3,000 as a depreciation on patent. So it is intangible assets. Even if the rate of depreciation not given, you should know the rate of depreciation for intangible assets. All the intangible assets carries 25% rate of depreciation. So no purchases here in the previous year, so it's a nil. So therefore you can calculate directly on a written down value before depreciation. So even if there was a purchases in the previous year, and if it was used for more than 180 days, then you can calculate directly on written down value before depreciation. So value for depreciation is important. You should not cross the limit of written down value before depreciation while you are calculating the depreciation. So that's all about this particular problem. Thank you very much.